Good morning. Welcome to the Summer Quarterly Bulletin. Let me introduce our Chief Economist, Gabriel Fagan, Luca Honorante, our Head of Monetary Policy Division, and John Flynn, Head of Irish Economic Analysis. So we'll kick off with a presentation from Luca, please.
Good morning. A few words about the international environment. Yes, let me start with the key messages. First of all, the euro area economy is ongoing and seems to be taking some robustness. In the past, it used to be driven mostly by external factors like net exports, and now internal demand seems to be progressively kicking in. Unemployment has been falling further, now it's 10.1%, and sentiment indicators are kind of hovering in a positive territory still. Inflation remains very subdued. It just turned positive in June at 0.1% and is not expected to pick up too much in 2016. Actually, the expectation is for 0.2% by the end of the year. This is due on this pickup compared to the past is due to the accommodative monetary policy of the European Central Bank and to the energy component, which is benefiting from base effects due to higher oil prices. When we go to the risks, well, this time it's quite easy to identify the main risk. The main risk are the economic consequences of Brexit. And a related risk that we have been observing in the days of the referendum is that the Brexit referendum has increased overall uncertainty, and this has put some pressure on the banking system, in particular in those parts of the banking system that have still a high number of non-performing loans. We have two boxes in the international part, which may be of interest for you. The first one is on labor market reforms in the euro area, and the second one is about China, about Chinese capital flows and the role of capital controls. Let me start with the economic recovery. As we said, the recovery seems to gain further strength. GDP has been picking up 0.6% in the first quarter of 2016, 1.7% year on year, just like at the end of 2015. Actually, the last number is more positive than the corresponding numbers of UK, US, and Japan. And the recovery has transitioned from one driven by net exports. So net exports were contributing positively, now less so because the global cycle, in particular in emerging markets that were export markets, has slowed down a bit, into a recovery driven by domestic demand, which is overall a good news. Yes. Let's look a bit ahead. We have no hard data for Q2. The first estimate of Q2 for the euro area will come out this Friday, but we can look at some partial information. First of all, unemployment. Unemployment in May has been fallen down at 10.1%. You look at if you look at the chart, you see that this value is kind of the best value in quite some time, in a few years. And sentiment indicators, notably the most recent, the PMI, have been going slightly down from 53.2 to 52.9, but basically they are still well above 50%, so in positive territory. We turn now to inflation. Inflation has been turning positive in June for the first time after a few months, and it's at 0.1% year on year. At the end of the year, it's not expected to go much higher, 0.2%, and then it's expected to go higher further in 2017. On the positive side, there is the contribution of the ECB accommodative policy, especially of the last measures of last March. And on the negative side, we see that inflation expectations, market-based inflation expectations, which are the only ones that we have at the moment, have been going down after the outcome of the Brexit referendum, about 0.1% long-term expectations. We come now to the thing you've all been waiting for, Brexit. So the outcome of the referendum was obviously a surprise, especially for the markets. It will be important for the UK in the outlook. For Ireland, I will leave the floor to John Flynn. We should probably not overestimate the effect for the euro area. On the one hand, the UK is an important trading partner for the euro area. It's like the second one after the US. And on the other hand, the openness is about 10%. So if these 10 should become 9 or 8%, the total trade would not change in ways that we haven't seen before. The main thing that we have been seeing is a raise of the general level of uncertainty. And so uncertainty about negotiation will be the key factor. The best possible outcome, let's say, would be a swift negotiation that reduces as much as possible the period of uncertainty, and a positive outcome, which means not simply WTO international rules, but something that is as little disruptive as possible, both from the point of view of trade and investment. A related risk is the fact that the results of the UK referendum could actually trigger a reflection on the process of integration. On the one side, we have kind of tendency of some parties in some countries to call for other referendums. On the other side, one could have also a positive risk, because this could lead politicians to think about a deepening of the concept of the union. We have no hard data on Brexit at the moment, so we are kind of a bit in the air. But what we have seen is that markets moved and basically came back after a while, so not something unseen before. We have seen movements in the exchange rate. In particular, the sterling has depreciated towards the euro. At the same time, there has been some kind of safe haven movement towards the dollar, so the euro has depreciated relative to the dollar, and the overall effect hasn't been dramatic. And what we see is that uncertainty indicators are on the rise. So this will be the main thing going ahead. Let me go to some numbers to conclude. These are forecasts of institutions, recent forecasts of leading institutions. Let me clarify, they do not include Brexit. So this is before the Brexit referendum. Real GDP growth is expected to hover up around 1.6% in 2016 and go slightly higher in 2017, 1.7%. When we turn to inflation, we expect low numbers for 2016. We are basically at 0.2, and then in 2017, inflation is supposed to pick up following the energy component at somewhere about 1.5% year on year. I pass the word to John Flynn. Cheers. Thank you.
Assessing, I suppose, starting off, I suppose the overall comment we make is that assessing both the performance and prospects for the Irish economy has been made more problematic, respectively, by two things. I suppose the scale of the revisions to the 2015 national accounts that we've seen, and then by, as Luke has been talking about, the outcome of the Brexit referendum in the UK. The recently published national accounts data for 2015 have resulted in a large upward level shift in the level of real and nominal GDP, mainly due to a sharp rise in the recorded growth rate of net exports, a very sharp rise. Now, as you know, the revisions were substantial, with the growth rate of real GDP rising to just over 26%. Real GNP now estimated at being just slightly below 19%, and nominal GDP estimating at more or less have gone up by about a third last year. Now, the upward revision to nominal GDP mechanically improves the most commonly used measures of the fiscal stance, and sort of impacts on their kind of usefulness or meaningfulness. While the scale of the revisions is exceptional, it's important to emphasise that the data is compiled in compliance with agreed international standards, and the revisions are explained, when we look at them, they're explained in the main by factors related to the operations of multinational companies, and in particular a number of things that we've seen going on in recent years. So we've seen some corporate restructurings, kind of where balance sheets essentially of companies have been relocated to Ireland. We've seen the transfer of intellectual property and other assets to Ireland, and then we've seen corporate inversions involving Irish entities. And we've also then seen a growth in aircraft leasing activities as well. And I mean, the combination of these things, as I say, has led to a substantial increase in Ireland's measured capital stock. And the economic activity associated with these developments has given rise to further strong growth in contract manufacturing, which has boosted growth of exports as recorded in the national accounts. So as a result, there's been a type of statistical onshoring of economic activity, with the national accounts now including a significant amount of economic activity carried out elsewhere but recorded as part of Irish GDP and GNP. Now, while GDP and GNP measures distort then the overall growth of domestic economic activity in Ireland in 2012, it shouldn't overshadow really the tangible improvements that we've seen taking place on the domestic side of the economy in recent years. Because if we look at a broader range of domestic spending and activity indicators, they suggest that domestic economic activity continues to expand at a reasonably healthy rate. So, for example, if we look at consumer spending, we've seen very strong growth in consumer spending. Last year, up by 4.5%, and pretty strong growth in the first half of this year as well, from what we can see. And that's been supported by solid gains in employment and rising earnings. If we look at investment net of aircraft and intangibles, again, the performance there has been pretty solid. We've seen double-digit rates of increase in machinery and equipment investment, and also in building and construction. So both of those, as I say, have continued to grow at more or less double-digit pace. A measure we've tended to look at, and we've talked about in the last few bulletins, has been what we've called underlying domestic demand. And underlying domestic demand, as we defined it, is made up essentially of personal expenditure on goods and services, net government expenditure on goods and services, and investment, excluding investment in aircraft and intangibles. And if we look at that measure, it grew by sort of 5% last year. And together with employment growing by 2.5% and compensation per employee growing by slightly more than that, it kind of points to growth in domestic activity sort of in the region of 5%, kind of give or take, maybe slightly more. These underlying developments probably present a more accurate picture of the underlying growth dynamic of the domestic economy. So it's important to keep these in mind then when you turn to look at the prospects for the economy and the outlook for the economy. Moving on to the next slide, I suppose. Looking ahead, kind of assessing the outlook for the economy, as I said, is further complicated by the outcome of the Brexit referendum in the UK. Our overall assessment is that both in the short term and the longer term, the economic impact of Brexit on Ireland is set to be negative and material. The close relationship between the Irish and UK economies creates a particular exposure to the Irish economy from Brexit. And while in aggregate we've seen that the Irish economy has become less reliant on the UK as a trading partner over recent decades, the UK remains a particularly important trading partner or a particularly important market for some sectors, particularly for indigenous firms. So if you look at sectors like agri-food, if you look at sectors like clothing and footwear or tourism, they continue to have a high dependency on the UK and could be affected to a greater extent than the kind of economy in aggregate might be by these developments. Now, the problem you have in trying to forecasting is that quantifying the impact of Brexit with much precision is difficult. Essentially, you can think of two periods. You can think of a transition or interim period in which the longer run arrangements are being worked out, and then you can think of the long term when the arrangements have been worked out. The difficulty in the transition period is that you could experience kind of heightened uncertainty and risk aversion. So there could be either a protracted period of that or bouts of that or spikes of that, which makes it difficult to sort of incorporate or think about when you're trying to forecast as to how you quantify that. In the longer term, the issue you have is that there's a wide range of possible outcomes here in terms of what the long-term arrangements may end up being. And again, that makes quantification difficult. So you end up thinking about different types of possible scenarios. Qualitatively, however, I think it's pretty clear that both in the short run and in the long run, Brexit is likely to adversely affect the Irish economy. If we think about the two periods a little bit, in the near term, the downside risks for the Irish economy, and this is also the case for the UK and the broader kind of European economy, the downside risks arise mainly from potential macroeconomic, financial and currency effects related to the uncertainty in the transition period and kind of ups and downs in that uncertainty. And an important element of that uncertainty revolves around the terms of the future relationship between the UK and the EU, how long it takes to work out that relationship, and then ultimately what the impact of the new relationship may be. In the longer run, kind of once a relationship is established, the impact of Brexit on Ireland will be influenced obviously by the nature of the relationship between the EU and the UK, and then obviously how both economies evolve subsequently. The nature and scale of the eventual macro impact will be influenced by the extent to which the arrangements change the free movement of goods, services, labour and capital, which is currently facilitated through the operation of the single market. And the channels through which we will see those things will be trade, the labour market and FDI. So they will be the things that we will need to watch. Now, as I said, in terms of thinking about what this means for the forecast, quantifying it over the forecast horizon is not straightforward because, as I say, not much can be said with precision about the scale and nature of the uncertainties or risk aversion that we might see in coming years. And heightened uncertainty and risk aversion could generate kind of macroeconomic, financial and currency market effects, which we're aware of. We've looked at this and then sort of tried to look at it in a couple of different ways. And one way we looked at it was we went back to some earlier internal work that we carried out in the bank, which looked at the potential longer run impact of Brexit. And we've tried to approximate the heightened uncertainty in coming years as closely resembling developments in the first 2 years of an adverse scenario where the UK leaves the EU without a negotiated bilateral trade agreement that falls back on WT rules. So we said, okay, we try and proxy the uncertainty in coming years in this way by assuming that it's similar to the first couple of years of an adverse shock. And these are the results that I show on this table here. Now, in doing that, we used a Bayesian vector autoregression modelling approach, and essentially what we did was we constructed a baseline scenario based on the expected path for foreign demand, if you like, in the absence of Brexit, and then introduced the Brexit shock, and so to see what sort of impact that would have on GDP in Ireland and on macro aggregates here. So, as I say, these estimates are shown in the table here, and reflecting the mid-year timing of the referendum, the estimated negative impact on growth this year, we reckon, is likely to be about 0.2%. But it's comparatively small, but it reflects the fact that this is happening in the middle of the year. So a lot of the things are already set for this year. We expect to see a more significant impact in 2017, and we've lowered the growth rate for 2017 as compared to our previous forecast by 0.6%. Now, as you can see from the table, this arises in the main from a less favourable outlook for exports. So we were assuming that the main channel through which Brexit will impact on us in the short term will be through its impact on exports, so it's seen as being less favourable. Investment is also projected to be adversely affected, and in part that's a reflection of the less favourable growth environment and also some element of heightened uncertainty. The results suggest a more moderate impact on consumption, but you would also maybe have to make an additional allowance for weaker consumer sentiment. So if we saw a sharp weakening of consumer sentiment, it could pull those numbers down a bit. And there's also an adverse effect, some adverse effect on employment. Now, more generally, we acknowledge that there's a good deal of uncertainty in doing this sort of exercise and in the estimates that we show here. But we've tried to cross-check them in a number of ways. For example, in recent days, we saw the IMF update its World Economic Outlook, so it came too late to be included in the international forecast. What it shows is in the World Economic Outlook update published by the IMF is that they've revised down their UK growth forecast for this year by 0.2%, and for next year by 0.9%. So these numbers on the back of that, and looking at what we've seen in financial markets and the exchange rate, I think are broadly plausible. We've also done a number of other exercises where we've tried to look post-referendum, if you factor in, say, these revisions and what's happened to currency markets, what might come out. And again, it points to something kind of broadly similar to here, so it broadly corroborates what we've seen here. Now, turning to what this implies for the forecast then, so if we look at the next slide. Sorry, just bring it up there. So that is the forecast slide. So in addition to these estimates of the potential Brexit impact, we're forecasting on the basis that the 2015 national accounts revisions represent a level shift, which is mainly related to corporate restructuring and which doesn't affect the underlying growth dynamics of the economy. So we're assuming that we've seen a level shift in 2015 and that it doesn't impact on the underlying growth dynamics. And then we factored in our Brexit estimates as well. So with these caveats then, our latest forecast is for GDP to grow by 4.9% this year and by 3.6% in 2017. And that's 0.2% and 0.6% lower than the numbers that we published in the last bulletin. Now, despite the rising uncertainty following the Brexit referendum, domestic demand is still expected to drive growth in the main over the forecast horizon. And the outlook for growth and consumption investment, or for consumption and investment spending, remain healthy, although as you can see from the forecast, growth rates are projected to moderate for both over the forecast horizon. And if we think in terms of the underlying domestic demand measure I was talking about earlier, that having grown by around 5% this year, we see underlying domestic demand growing by about 4% next year and by just under 3%, or sorry, about 4% this year and by just under 3% in 2017. And this projected slowdown reflects obviously some impact from Brexit factors. Looking then at the various components of the forecast. So if you look at consumption, consumer spending grew by 4.5% last year, which is its fastest rate of growth in quite some time, almost a decade. And while some of that was a catch-up for weakness of consumer spending in recent years, the main driver has been the pick-up in the growth of employment and incomes. We've seen fairly positive data for the first half of the year in terms of consumer spending. And on the basis of that, and supported by continued solid growth in employment and incomes, which we factored in for this year, we see consumption growing by 4% next year. Now, on the back of a slowdown in employment, which we would have seen as moderating anyway, but then maybe we added to a little bit by Brexit, we see consumer spending slowing to about 2.3% next year. Investment obviously is quite difficult, given the revisions to the national accounts. But the Brexit decision has motivated some downward revision to that. And in the main, we focused in on machinery and equipment investment because we see maybe the investment decisions there being either delayed or we see lower levels of investment in terms of machinery and equipment. We still see fairly positive growth in investment, but if you look at underlying investment, excluding intangibles and aircraft, we see that growing by about 6% on average over the 2 years. Exports and imports obviously are difficult, but as I say, we're forecasting on the basis that the revisions to the trade figures in 2015 are treated as a very large one-off level shift, and accordingly, we assume that these revisions are taken to apply a change in the level of exports rather than in the rate of growth. So on that basis then, reflecting kind of weaker external demand and a less favourable external environment, we project that export growth will moderate with growth of 6.4% this year and 4.5% next year, and that import growth will also moderate as well. So we see that kind of moderating, and inflation basically we continue to see inflation is pretty low at the moment. We continue to see it staying low next year and rising modestly the following year. Now finally, the balance of risks in this case. I suppose the key thing to say is probably that while uncertainties in relation to Brexit dampen growth, the economic outlook is still relatively favourable, but there are risks, and the risks projections are firmly rated to the downside. And these risks reflect the possibility of a more adverse impact on the UK, the possibility of a larger spillover, as Lucas mentioned, to the international economy, or the potential for more negative domestic effects, so that we see impacts on consumer investor sentiment, and we have to keep an eye on that, or we see adverse labour market effects. So that would broadly summarise the outlook for the domestic economy. So I'll return to Gabriel. Yeah.
Thank you very much, John. As you know, forecasters always tend to say that it's a very difficult time to forecast. There's so much uncertainty out there. Well, on this occasion, it's actually true. If you think of what's happened, the revision to GDP numbers last year and the outcome of the Brexit referendum means we're in a period of extremely high uncertainty regarding the prospects for the Irish economy. As well as this, some of our key metrics that we use in economic analysis, but also in public finance analysis, fiscal policy, have become much less meaningful. If you think in terms of things like ratios to GDP, the deficit to GDP ratio, the debt to GDP ratio. Just to give you one example, as a result of the revisions to GDP level, the debt ratio for 2015 falls from 94% to 79%. That's a very dramatic change. And in a context in which the actual level of debt measured in billions is still the same, and in a sense the capacity of the economy to service that debt is still the same. So our traditional fiscal ratios now are becoming less have become somewhat less meaningful than they were in the past. In addition, the fiscal rules, the European fiscal rules that we have, depend very heavily on GDP and related concepts. So they depend on the GDP, as I mentioned, but they depend on measures of potential output growth. They depend on measures of the output gap, the gap between the potential level of output and the actual level of output. All of these indicators, which in any event had problems in the Irish context before the revision, have been heavily distorted and are likely to be heavily distorted by the revisions to the GDP numbers that were published recently. So in the context of the public finances, how should one react in such an environment? Well, I think the natural thing to do, and what we would be suggesting, is to shift focus a little bit from ratios in terms of GDP to nominal values. And in terms, if we do that and we take the previous plans that were there, this would suggest, for example, in our view, that instead of talking in terms of GDP ratios or in terms of structural changes in the budget balance and so forth, one should focus on the overall nominal figures, at least give more weight to the overall nominal figures. And that would have an implication that governments should aim for a budget balance which is close to being balanced in 2018 in nominal terms. A second important lesson that we learn is, and we have learned this in the crisis, is we've seen very dramatic upward revisions in GDP as a consequence of the restructuring of multinationals. In the future, there may be additional multinational restructuring, but it may not necessarily lead to an upward revision. It could be a downward revision if companies decide to relocate their intellectual property elsewhere. So this puts an additional source of risk there. And in that context, it's very important to learn the lesson of the crisis, which does that the government has to be careful in relying on volatile sources of revenue, which may turn out to be transitory, which may be reversed if there is some shock, in order to ensure that there is a pursuit of a prudent fiscal situation. Now, it's clear, as John has clearly documented and set out there, Brexit is set to adversely affect growth in both the short and the long term for the economy. Some effect is already incorporated into this forecast in the Bulletin, but it is it's an estimate. There are lots of issues that are surrounding that. For example, what assumption do you make regarding the nature of the relationship between the UK and the rest of the EU post-Brexit? what tools, what models, what information you have to take. So the severity of this impact is difficult to gauge. It is an estimate. And we think that when we look at what we've done, we can certainly see that the impacts on the Irish economy could be larger than what we have penciled in to the forecast. So there is a downside risk. But in any event, there is really quite a considerable amount of uncertainty both ways about facing the Irish economy as a result of Brexit. So in this environment of heightened uncertainty, I think the best path that policy can take is to try and bring stability to the economy, reduce the degree of uncertainty by sticking to a steady medium-term orientation, by adhering to the sort of fiscal plans that have been announced and adopted, and so as to reassure both the public and the markets that things are on the right track, and that the economy will be in good shape to withstand the future shocks that may come down the tracks. Thank you very much.
Thank you. And we're now open for questions, and if you could just wait for the microphone, please.
Sorry, we just one thing. That you have the articles.
I just mentioned the articles, yeah. So on this occasion we have 2 articles published in the Bulletin, on the right page. And these are, and we have the authors here, so if you want to follow up on any of these. And the first article is produced by our Statistics Department, and it looks at estimating the amount of cash buyers and transactions volumes in the residential property market since 2000. So we have the authors here. If you want to, if you have any questions on that, plus there is a video available on the bank's website, kind of where that article is discussed. And then secondly, an article from our Financial Markets Division, which looks at developments in Eurosystem monetary policy operations over the past year or so. And again, the authors are here if you have any questions on that. So just to mention those two.
Can I take a first question? Conor Humphreys, please, from Reuters.
Thank you. Can you put any numbers on the kind of likelihood of the worst case scenario? Slightly, in terms of the Brexit impact, are you what kind of probability are you assigning to the various scenarios?
I mean, kind of as I mentioned when I was talking about one of the issues in quantification is that there's a wide range of possible outcomes here. So you've got everything from, on the one side, a European Economic Area arrangement to somewhere in the middle, and it would depend on what shading of it, some sort of series of bilateral negotiated trade agreements, to, in the absence of that, kind of WTO rules become the default. Now, the way we've thought about these is to think about them as different scenarios with different outcomes. An EEA scenario would have a much milder impact if that was what emerged. WTO is the most adverse. But we haven't, I mean, the signals on, in terms of where this goes, we're probably at early stages. Signals keep changing, so we can't think really about, well, is one more probable than another. I mean, we know what the best outcome for the Irish economy would be, but it depends obviously on the UK's choices here, and then it obviously has to be negotiated and agreed at EU level as well. So we haven't thought about sort of probabilities or weightings in that way.
Actually, just one more question. Just on the CSO issue, do you have any recommendations in terms of changes to methodology or kind of alternative indexes that would be preferable to the kind of GDP, GNP? I mean, what can Ireland do about these anomalies?
Well, it is a good question because it raised the point that I wanted to make in any event, that the CSO has announced it is establishing a group to look into the construction of alternative indicators which will give a more accurate predictions of what's going on in the domestic economy. And we very much welcome that establishment of that group, and we are actually going to participate at a senior level in the group. The group, I think, will report sometime in October or thereabouts of this year, which will start its work very soon. So we are involved in this, and we will be actively participating in that. We have in the past, as John mentioned, come up with indicators such as underlying domestic demand, which we think gives a more accurate picture of the underlying economy. We've also published, for example, in our, I think, the last quarterly bulletin, a heat map of growth in Ireland, which sort of combines a range of different indicators. So there are a range of possibilities which can be used. And I'm sure this group will look into all of those in great detail and come up with some useful indicators which will play a prominent role in future of analysis of the Irish economy.
I do apologize.
Thank you, Eamon.
Sorry, apologies.
Thank you,
Just the
Examiner.
same point. Does this new whatever CSO comes up with, will you press Europe or the EU to take on these measures?
Well,
for the ratios.
I think the issue of Europe is different because the sort of problems we have in Ireland are so extreme, such an extreme case, such an open economy where the actions of a small number of companies can have very major impacts on the aggregates. That's not the case in other euro area countries. It's not the case in the euro area as a whole. So from an euro area point of view, I think it is probably not necessary to use such indicators. However, it's very important, and here we will be very active in the various fora in getting across the message that to understand what's going on in the Irish economy, you have to be very cautious in using numbers like headline GDP. And this is where these other indicators will come into play, and we'll be more than active in drawing attention of other European authorities to these, particularly in the context of the euro system. Yeah.
So Colin Kelby from the Irish Independent.
Thanks. Just on that same issue, you and others have long warned about the impact of GDP in the Irish figures and so on. But was the extent of this envisaged, do you think? I mean, did this come as a surprise to you when it was announced, or did the scale of this?
Yeah, I mean, I think, as was said, I mean, some of the issues that are involved are not new, like aircraft leasing, redomiciling of firms, contract manufacturing. We've talked about these in the past. But the sheer scale was completely unanticipated. So we essentially had only a very short notice. I think we learned about the numbers just shortly before the official publication, and the magnitude, I think, shocked or surprised us in some ways, and I think it's the same for all other analysts of the Irish economy. So it was a really dramatic revision, unprecedented, and something that we were not anticipating.
Thank you. Maybe another question from Conor, and then we'll...
Sorry, just quickly. Would you have concerns that there are kind of fundamental instabilities in the Irish economy which are reflected in these numbers, or is it purely an accounting issue? I mean, would you advise the government to look at maybe reducing these flows? Is there dangers to the Irish economy from these from the things which caused the huge jump in GDP, or is it just an accounting anomaly?
Well, there is an accounting issue very clearly, but I think as I tried to get across the message, there's also an uncertainty that is being added to the economy by this vulnerability or impacts of transactions by a small number of companies on overall aggregates. I don't think we would go from that to say the government should take policy action. I mean, I don't think that would necessarily be warranted. But certainly in terms of analysis and in terms of preparing the public finance, making sure that the public finances are in a sustainable and sound footing, these uncertainties should be taken into account.
So Laura Slattery, please, from the Irish Times.
Just on that point, you mentioned the possibility that we would see a downward revision on that scale. How likely is that?
I don't necessarily think it's likely, but I mean, these sort of events, I mean, we've seen dramatic movements as a result of transactions by a few individual companies in one direction. We can't assess, we didn't anticipate the magnitude of this. there's nothing to rule out that there could have movements in the other direction. So one should be very cautious when we're in an economy of this kind, where individual transactions by a small number of companies are dramatically affecting your headline numbers. That just tells you be cautious. It doesn't necessarily mean there's going to be a reversal, or it doesn't mean that we will see a downward effect, but what goes up can possibly come down, and one should be aware of that possibility.
And just on the Brexit negotiations timescale, do you have any expectations along those lines? You mentioned the possibility that the interim period could see a lot of risk-averse behaviour, and I presume you don't want to see that period being protracted, indefinitely.
Do you want to take that?
Well, I suppose the timetable, as it's kind of formally laid out, is that once the UK gives notification under Article 50, there's this 2-year clock running. Now, there's quite a lot to conclude and to be agreed in a 2-year period. So it would be hoped that could be done, or that could be done without any great delay. But I mean, the key in terms of uncertainty and sort of spikes in risk aversion, the key, I suppose, would be that there would be good progress or solid progress made, so that it would be pretty clear kind of where things are going. So if that was happening, then it probably makes the situation more manageable. It reduces the adverse impacts. If that is not happening, then, and it looks like the period is drawn out, then it probably becomes more problematic. But we're very much in the early stages of this. I mean, the best thing would be to stick to the timetable and to for there to be sort of good progress in terms of where it's going, so that we would have a clear picture. So that would be the best outcome if it could happen.
Okay, Colm Kelpie, the Irish Independent again.
Thanks. I know you've been reluctant, Gabriel, in the past to talk about the specifics of budget policy or budgetary policy, but in terms of the €1 billion fiscal space this year and the summer economic statement and so on, in light of what you've been saying this morning about the uncertainty and the Brexit stuff, is that the government has said there's no impact on the fiscal space this year and so on. Is that a wise decision, do you believe, or what impact do you think it should have there?
Well, as you say, I'll stick to my traditional policy of reluctance, but I do believe that looking forward, we will see some estimates. The expenditure benchmark will change as a result of these revisions. The structural budget balance estimates will change. So, but these changes, they are mechanical computations, which don't have particularly significant economic meaning when we think of the prospects of the economy. That's why we say maybe it's best at this point in time to put particular weight on nominal measures, nominal deficits and so forth, rather than getting into these ratios and complicated adjusted ratios where the computations really are heavily distorted by what we've seen happening in 2015.
Okay, thank you very much. Are there any final questions?
I suppose
So,
again,
Eamon Quinn, yeah, thank you very much.
I suppose again, same issue. There's a small number of Irish sectors which are in the firing line. You don't recommend any special treatment
For Brexit, you mean?
Yeah, due to Brexit, for agri, for clothing, and other key exports.
I mean, no. I mean, in terms of, I mean, this is an issue for the overall economy, and as I say, for the if you look at it in aggregate, overall trade dependence on the UK market has gone down, but obviously there are certain sectors which are more dependent than others. But I mean, no. I mean, we've seen. Kind of one of the things we've seen is that, say, if you compare now to kind of periods in the past when this has happened particularly long ago, the economy has become much more flexible. Its ability to absorb things has become much more flexible. I mean, what's interesting to note is that while there's been significant movement in the sterling exchange rate since the referendum, I mean, the current level of the sterling exchange rate is broadly similar, or even, I mean, it's slightly different than but broadly similar, say, to the average of what we've seen, say, in the 2009-2014 period. In fact, we've lived with kind of a higher euro sterling rate in the past. So again, I mean, it's about relying on the flexibility of the economy. I mean, we've seen over time that trade has diversified as well, and trade patterns have diversified, and you can probably expect to see more of this, a little bit more in the longer run anyway. But I mean, it's not something that we factored into our forecasts, but it would be a natural reaction to something like this.
Okay, well, if there's no further questions, then we'll close. Thank you very much.
Thank you very much.